Good afternoon, everyone, and welcome to another one of Avant-Garde's free educational trading webinars. We are thrilled to host Vlad Karpel and Keith Harwood is actually joining us this afternoon as well. They are both here to talk with you all about trading butterflies, market neutral strategies, and yield-based trading. So we are happy to have them back. Vlad, Keith, are you with us?
Yes, I'm here. Vlad, I think you're muted.
Hi, Keith. Yes.
How are you doing today,
Can you
Natalie?
hear me, friend Keith? Doing well. Thank you so much. Thanks for joining us. Vlad, are you there?
Yes. Can you guys hear me now?
Yes, I can. Wonderful.
Yeah, loud and
All
clear.
right, awesome. Okay, great. So Vlad, if you are ready, you can go ahead and pull up your presentation. And I'll remind everyone with us who's live in the Zoom room, if you have questions during the presentation about the presentation, please feel free to type those into the chat or the Q&A, and I'll get those over to Vlad and or Keith to address.
Perfect.
Whenever you are ready, sir, you can share your screen.
Let me know if you guys can.
Okay. Yes, I can see advanced options butterfly. Feel free to take it away when you're ready.
Sounds good. All right. Again, thank you, Natalie and AGT, for hosting this webinar. Today's topic, butterfly. Probably not the most common strategy, but I think a very powerful strategy that, one of the reasons, at least I like, we'll get feedback from Keith, butterfly, that you can structure your trade where you can risk little premium, right? You can buy something relatively cheap, right? In terms of percentage of underlying stock price, but you could have this outsized return, right? If you find, you have to be correct on direction and time, just like on most option strategies, but that's the advantage of the butterfly, and we'll talk about that setup. Again, for those of you who are new, welcome. I see a lot of familiar faces, or at least names. Can't really see the faces, but my background, for those of you who are new, is in technology. I was executive vice president and CTO of several publicly traded companies here in Chicago in fintech space. One of them was Options Express, worked for different brokerages, firms, and hedge funds. And my background is building technology, building AI solutions, building in different analytics to help manage portfolio, to help find opportunities in the market and signals. And that's my background. I've been doing that for over 25 years. I've been mentoring and teaching, yellow tunnel subscribers how to trade stock and options. And, super excited that Keith from Options Hotline was able to join us over a year ago to help bring perspective of trading. His background is market maker, worked at hedge funds, and he's expert. I'm learning a lot from him in terms of options and nuances of options. So Keith, you want to give a little overview from your perspective?
Yeah, absolutely. So thank you, Vlad. And yeah, so for me, I started as an options market maker, as Vlad mentioned, back in 2005. So after graduating college, went down to the floor and worked as an options market maker over 100 stocks and most of the equity options exchanges. After doing that for a few years, I was an options market maker in gold and silver futures, as well as European bonds. So I kind of traded a little bit of everything. After working through the market maker side, I actually switched over to proprietary trading. And as Vlad mentioned, working with a commodities-based hedge fund, working with them on implementation of option strategies given a directional bias. So that really helped level up kind of my approach to options, comparing a directional bias, which we get from this technical analysis and the AI analysis that Vlad's incredible at, to really try to fine tune the best expected value trades, and moved over to the educational side back 8 years ago to work with individuals in terms of better implementing trading strategies using options given a view on the market. And so really excited to be working with Vlad. His AI models really help a lot with finding those opportunities. And then I try to help bring in my perspective from the options markets on ways that we can implement these ideas that are already great in a much more nuanced way, taking advantage of all the tools that the market has to provide. So really excited to be working with Vlad, really excited to be here today, and looking forward to talking more about these butterflies.
Perfect. We already went through disclosures. This is just another reminder that we're going to go through some trade ideas. These are just an ideas. This should not be taken as an advice. So this is purely for educational purposes and information purposes only. I encourage you to pause the screen if you haven't read these disclosures before, so you can understand the risk and suitability. All right, let's jump into the butterfly. Butterflies, what's the definition of butterflies first? And then we talk about when would you consider entering, butterfly as opposed to just single call, right? The most common strategy is people buying calls. That's majority of the volume on exchanges, or puts, right? You can buy puts. But when you start new, majority of, you don't think about bearish, right? You think market always goes up. And one way to leverage is to buy calls, right? If you go through, as your journey as a trader continues, then you realize if you have a stock position, you can also buy puts to hedge your portfolio. So when do you trade butterflies, right? Butterflies, I mean, the main one is further cost basis reduction, right? Because calls are expensive, especially, if you were trying to do a butterfly today and market is down and VIX is going to 20, 25, 28, we've seen as high as 28 in the past couple weeks, right? Because of the uncertainty with tariffs, uncertainty about China-US relationship, evaluations, and so on and so forth, right? Government shutdown, people getting laid off, right? There's a lot of uncertainty in the market, and then as the uncertainty rises and the volatility rises, puts and calls are expensive, right? Buying, at the money or near the money options, or even out of the money option, they're expensive. So how can you still participate in market if you have especially limited portfolio, right? If you have a small portfolio managing $1,000, $5,000, $10,000, how do you participate in these markets if you have an opinion on the market? So butterflies is definitely one of the cheapest way to participate, whether it's an earnings event, right? We had earnings from Qualcomm, right? Today, last night. So you can participate in these earnings or ARM, right? Arm holding by doing these structured trade as a butterfly, and you have the limited risk to the downside, but you have a very large disproportionate, right? This is where you can make 100% return, 200% return, 300% return on your investments. But you have to be careful in these strike price selections and expiration months, right? You have to have an opinion on the stock, on the market, on the time and the magnitude, right? So it's a little tricky. It takes time, but we'll find some shortcuts or some hints that can help you do that. So butterfly spreads are traditionally done with either calls or puts, right? You have basically 3 different strikes. You have 2 long and a short strike, right? One short strike is usually the middle, right? And then you have the wings, the long strike. So you have 2 short strikes in the middle and 1 long strike outside. You can be long butterfly or short butterfly. So, sometimes but we're going to talk about just a regular butterfly where you buy 1 long call, sell 2 calls, and buy 1 calls out of the money. Not the money, but the long. So the expiration months and increments between strike prices for all options should be the same, right? I mean, you can have a broken wing butterfly where one side of the strikes is 5, some of it is 10. But that would be the setup, right? Usually it's same expiration months and it's equal distance between the short and the long strikes. When I learned butterfly, I think about it as just a spread. If you understand what a spread is, long vertical call spread, right? Butterfly is just 2 spreads, where one is the long spread, debit spread, one is the short spread, credit spread. But that middle strike is the same, right? If they're different, then you have, iron condors, or call condors, not iron, but call condors, right? So that would be how I would visualize it. And we have a few slides that does that. So again, and out of the money, in the money, you have to have a view on the market, right? You have to have a view market. You can have a market. Butterfly is considered to be a market neutral strategist, but that means that you think that the market is, or the stock is just going to stay where it is now. But if you think there is a directional move, let's say by end of the year, if you think market is going to rebound from the current pullback, right, or continue to go in lower, then you can have a directional butterfly, right? But the most common depiction and usage is that you think stock is just gonna, or stock market just gonna trade in this current range where it's trading right now. So you're selling out of the money call options, right? Let's say spiders. Right now, it's last time I checked we're 680. We were breaking some of the 6,700. It's a 6,700 on SPY.
Yeah, 669, 670 range.
Right, so 670, right? So you think if by end of the year you think we're just going to trade in this range, right? 50-day moving average, right? Sounds like a reasonable place to end the year. Maybe 700, right? Maybe we get to the 700, revisit the 700 in between. But also with uncertainty and employment rise, and maybe revisit October lows, right? Some 650 level. So if you think that this is what the market is going to trade, and we're just going to have a choppy market that trades in the range, then you can say, okay, I'm going to select the middle strike, at 680, 670 level. And then my wings, that's the short call. And then my wings would be 700, let's say, and, if it's $30 difference, then let's say 640, right? Or 650, 690. So you're buying in the money call option, right? You're selling two strikes, selling two, at the money or out of the money options. And the idea is that you use the same underlying asset, right? So let's say spiders or stock like Qualcomm that announces earnings. And so same contract expiration and select strikes based on probability of success in analytics, right? You have to have a view on the market and on the underlying stock. So if you think that the market is going to be actually, let's say it's going to reach 640 because government shutdown is going to continue. We're not going to have a data, and once government shutdown reopens, let's say I don't know, end of November, right before Thanksgiving, a lot of people think that government will reopen. Then we have unemployment data, and all of a sudden, unemployment data is they have a significant tick up in unemployment data. Well, then maybe then you would select the strikes. Maybe the short strike would be 650, going to 630 and 680 directional selection. But you do have to look at the probability of success and analytics, right? So let's look at some of the examples of butterfly, right? Strike price selection is important. Expiration months, it could be end of the year. Some people use butterfly for weekly options that expire next week. But if you look at the again, Avant-Garde platform, I actually try to prepare some of these questions ahead of time so we can get a little bit more organized and just get a faster answer. All right. So I basically say, help me visualize a butterfly if I think spiders will settle near 7,000, right? I'm still bullish on the market. I think market is going to be choppy, but still I think we'll settle somewhere near 7,000 by end of the year. And then you get an answer, right? Absolutely brilliant question. I like that. Visualizing butterfly spread is one of the best way to understand the risk and reward profile, right? So butterfly spread payoff targeting 7,000 by December expiration. So it's designed to profit spider settles close to that middle strike, right? If you look at the profit and loss, the maximum profit, if you're correct on the strike, you don't have to be exact, right? You don't have to wait till December 31st or the third Friday, the monthly expiration on this strike price. As long as right now we reach the bottom and slowly start gravitating towards 7,000, your butterfly, as time decay occurs, your butterfly will start increasing the price as long as we are approaching 7,000, right? So we don't have to settle at 7,000. You can see where a different strike price you get a different profile, right? And you break even is at the debit. Butterfly, right? In general, long butterflies is a debit strategy, right? So in this example, you're paying maximum loss is $100, and maximum win is $150. So that's maximum profit occurs if SPY settles exactly at 7,000, right? And you can use this. I encourage you to use AI, especially an AGT that's optimized for making option decisions, financial decisions, and trading that can help you kind of navigate through some of these decisions by asking the same kind of questions that I just posed or similar. Losses increase as spiders moves further away from the 7,000 level, but are kept, right? And break-even points is the debit, right? The debit that you paid, plus minus the strike price. So this strategy offers limited risk and reward, ideal for neutral outlook with a strong conviction on settlement range, right? But it can also be directional, right? If I think it's going to go to 7,000, I choose 7,000. If I think it's going to go to 6,500, I choose 6,500. If I think it just stays where it is, 67, 6,800, then I select 6,800. And remember, Winston provides info, not advice. Okay, good. So the question is, the second question, there is this two follow-up question. Well, what the expiration months do I select, right? Which expiration months do I select? The way I use it, and we'll get Keith's perspective. Usually, you want a liquid option. You want tight bid and ask spread. This option strategy will not work if you have very wide bid and ask spreads, not liquid names. So here I'm using an example of spiders. You might want to use it as a hedge. You're hedging your portfolio, buying spiders put spread to the downside, right? Or you can buy call spreads, targeting that spread. Same strategy. But you can see here, I'm looking, great question. Tracking open interest by expiration months is a smart way. It's very good AI. It always gives you some words of encouragement. I like that. Gauge where market participants are most focused, right? As of November 6th, SPY options, SPY, SPX, show the expiration highs is in December, which is very unusual, right? Usually it's the front months, November, but people are concerned about, government shutdown, that it's not going to happen until Thanksgiving, rising tensions between China and US on some of the chips production and availability. So people are hedging now in December. So if you want liquidity and you want highest open interest, then you go into the months of December. And I pulled the December months here on the option chain, and you can definitely see, if I look at the open interest, you can see 700, right? That 7,000 strike has most of the positioning right now, what is called call wall, right? Call wall. And you can type inside of Winston, just say, hey, can you explain what a call wall is? Right? But it's basically a strike price where there is a highest, interest, open interest. People are very interested in 700 level by end of the year. So that would be one. If you think that the worst is behind us, and we're entering the time from seasonality perspective where the market is bullish, this is the months you want to select. And then in terms of the strike price, I usually go to where the highest open interest if I have a directional bias in this example, right? If I'm bullish, I would probably select 7,000. If I'm bearish, we can go to the puts and look at the highest open interest with puts. So that's this. December leads in open interest, reflecting higher trader and institutional activity. High open interest can signal greater liquidity and potential tighter bid and ask spread, and that's what we want, right? Then the next question, what strike price in SPX has highest probability of reaching by end of this year, right? You can run different simulation analysis, Markowitz model. You can look at the open interest. You can look at, some of the analytics that we offer, and, fine. But, according to Winston, the highest probability right now, 7,000, right? So it basically shows this probability, SPX range, and based on culture prediction market data, okay? And most probable range is 7,000 to 61. Kind of confirms this high open interest, right? The question is, it doesn't matter what Vlad thinks where the market is heading. It doesn't matter what Keith thinks where the market is heading. Majority, going back to game theory, what does majority of people think, right? What is the market makers? What do, wealth management, what does Goldman Sachs thinks, what does JP Morgan thinks, because that's where majority of the volume is going to come from, is this institutional sovereign wealth funds, right? And right now it's 700, right? So based on this, it says, okay, this is your range, highest open interest is 700. Okay, that's something that makes sense. And it gives you actually probabilities, right? Where the highest probability of reaching, 7,600, that would be an outlier, right? Probably not going to happen by end of the year. I mean, it could, right? It could. Government could reopen. We can have more mergers and acquisitions. Nvidia can go up by another 100%. So along with Tesla, so it's possible, but highly unlikely, right? So trading is based on distribution of possible outcomes. So you want to find the strike price that has highest probability based on your outlook, whether it's bullish, bearish, or neutral. All right. Let's continue on. So here, I selected 700 strike for SPY when I did this structure. This was before the sell-off. I selected 700. Still sticking to it, but that's my opinion, right? Doesn't have to be I'm right or wrong, but if I think by December we're going to reach the 700 strikes, then I propose buy, or at least not me. This was Winston basically says, well, buy 680 call, sell 700 calls, and buy another 720. So you're locked in this range. So as long as the market is going to settle between 680 and 720, ideally closer to 700, the closer you get, the higher the profit is, right? But if we settle below 680 or if we go through 720 strikes very rapidly, that's when you're locked into your maximum loss, which is your debit, right? So that's idea of maximum loss and maximum gain, right? Maximum loss if we're below 680, maximum gain if we're at 700, maximum loss again is if we're above 720 or above. So you buy one call at the lower strikes, two calls middle strikes, and the fantastic things I'm going to give some credit to the Winston is that it's pretty sophisticated. AI's models are pretty sophisticated that if you tell her what your outlook is, you can ask what is the optimal strategy, what is the most cost-effective strategy, which strategy has highest probability of success. So I encourage you to use Winston to help you navigate and structure these trades and select proper structure. So again, market outlook is important, right? You can't just structure and butterfly unless you have an opinion on the market, right? Or on earnings, right? If I think Qualcomm has very high open interest and skew towards the calls, everybody's buying calls, and I think from technical and fundamental analysis, earnings consistency, they can continue to profit, then you could have a directional trade, right? If you think it's locked neutrally, then you can just do a butterfly that settles in the current range. Or if you have bullish bias or bearish bias, then you would move that short strike. You would move the short strike to where you think it will gravitate. And usually you would look at the highest open interest, right? That's where if the stock has moved to the upside, you find the strike price within the expected move was the highest interest. Again, risk limited on both upside and downside. Usually you structure your trade where there's a lot more upside than downside. It's a debit strategy, right? So you do have to pay debit, but it's probably one of the cheapest strategy you can find in terms of participating in trade. You do want to review IV rank, right? To make sure that if what your view on the volatility as well, right? Because if you buy a debit spread, and volatility rises, your butterflies will also. So it's a great strategy after earnings or low IV rank in general. Because it's a debit strategy, you pay in debit, you want it to low IV rank. Because if you buy in a high IV, you buy a debit spread. If the market doesn't do anything, but this drops, let's say from current level 20 to 15, then your butterfly will cost a lot less, right? And that's what Keith likes to avoid, where the market doesn't, we talked about this with gamma, same thing with the butterfly, even if it's the same expiration, but volatility drops, then all of a sudden your debit strategy worth a lot less money. All right, Keith, what's your favorite? Like, when do you use butterflies? When you don't use butterflies? How do you select strike price expiration months? What are some of your insights?
Yeah, I appreciate that. A couple things that I always try to factor in when I'm looking at butterflies is number one, I don't want too long of a time to expiration. So, I've had times where I've talked to people and they look at a current market environment and say, well, I want to try to pinpoint where the market's going to go in 6 months. And if you're starting to get into that point, the butterfly doesn't really give you a lot of leverage if I'm trading a March or a June butterfly, because at some point I need to start collecting some theta. 1 to 2 months, that's about the maximum time frame that I would look at for a butterfly, or using it for earnings where it's really just a weekly trade and it's all about trying to get that big leveraged return. The other thing I think that's important is making sure that the wings and the body are separated enough that you've got a window of success, because I can put on a very cheap butterfly in December by buying the 699, selling the 700s and buying the 701s, but my window is $1 or $2 total, and that just doesn't actually work out unless I absolutely nail this trade. And so yes, that gives the highest return, but it's also the lowest probability of capturing my window. So those are a couple of the big things I think that people always need to remember, is making sure the butterfly has a window that gets you your return, as well as the time frame. And going out too long or too tight creates a lot of problems for people.
Yeah, so I thank you. No, thank you. This is great. And speaking of the range, right? Going back to the bell-shaped distribution curve, you basically, let's see, how can I annotate? Yeah, so if you think in this example, right, we're locked into a certain join, share. Maybe I can. So if you think we're locked in a certain range, right, going back to the bell-shaped distribution curve, right, let's say we're locked to between 690, you think we're going to be between 690 and 710, right? Then you select 690, one time, you sell two strikes, 700 and 720. That's 1.5% range. Most likely on VIX, especially jumping above 20, is going to be a little bit wider range. So then I select 680, right? If I think we're actually going to be somewhere between 680, 700 and 720, then this is my premium that I'm paying, right? Debit strategy. I'm going to pay 486. It tells you what the natural ask of this butterfly is, right? You buy one at the ask, right? You sell two at the bid, right? And then you buy one at the ask, right? And then, you can try to target. It's a liquid name, so you can target middle strike, the midpoint between natural bid and natural ask, or you can target 492. But here, that it's the most I can lose is, in this example, a little bit less than $5. This is the most I can lose is $5. But if I'm right and we do get to 700, or we start moving towards 700, then the maximum profit is the difference in strikes, right? So it's $20 minus the debit that I pay. So I can make $15. Again, you have to market has to settle on 700 by December 19, which is very unlikely. But you don't have to wait till December 19 to close your spread, right? If you bought for $5 and the spread moved to $7, you can use your trading plan that Keith is very good at and can always help you to maybe lock in 50% profit, right? You don't have to wait till the spread is $15. If you have a rebound, we start gravitating toward, back to 680, back to 690 level. Okay, then, the debit spread that was $5 is now $7. Any questions on how to structure butterfly using these option chains, or any questions on the Winston? Oh, friend, I love the name Winston. Any questions? Okay. If there are no questions, so, just again, this is the Winston's attempt to show you that you have two, one is the bullish spread and one is the bearish spread, right? So you have, in this example, I'm buying 80 call, selling 95 call, buying 110 call, right? And then just basically say, visualization of debit spread versus credit spread, right? So these are the debit spread, right? The blue bars, and these are the credit spreads. Different visualization, but I always look, kind of the always, okay, this is the bullish spread, this is the bearish spread, and the only difference is that these strikes are the same, right? That's how you got to that butterfly profit and loss. So some people do that, like I sometimes do. You don't have to put butterfly all at once, right? You can buy a debit spread, right? And wait till the market starts going in your direction. And if you want more profit, okay, or you want it, then you put on the credit spread, right? Or vice versa, right? So they don't have to happen all at one instant. You can buy a call spread, debit call spread, and then buy credit call spread when the stock moves in your direction on the stock market. So again, just to reflect, main question is what is the optimal strike? That takes time, right? I was looking at the earnings like today. There's really no liquid name. Like Win Resort is one, right? You can let's look at Win Resort. I mean, I usually target, but if you have kind of a neutral view on Win Resort, it's not going to really hit a home run or get strike out, then same idea, right? You can look at the strike prices, right? Like 120, you can see the highest open interest at 120, and you can do market neutral, where you select 120 as your middle strike, and then maybe target, estimated move analysis. Estimated move is 6%. So you select your wings, 6% to the left, or 10% to the left, 10% to the right, and then as long as it stays within the range, and then that's how you would construct the butterfly. You don't really see any big spikes in open interest like Qualcomm today. No, not Qualcomm. My favorite, what is it? F11. What's the F11 sticker for that? Everybody loves F11 ticker. APP. So it's actually, up only 2%, I mean, despite the market. But you have these high open interests, right? Because it moves. It's a retail stock. It moves was, during earnings to the right or to the left, right? The large move to the upside, to the left. Expectation was 6%, right? So, but you can see a lot of people are gravitating towards 700. And if you look at the call and put skew, a lot more activity in calls than there are puts. So if you think, we can get to 700 level, then okay, this is your example of a butterfly. If you think market is going to start recovering and F11 is going to come back, then this is your opportunity. Or you can go back to your Winston and just say, where do you think F stock will trade by end of the year or end of the month, and the start of the month? Or whatever analytics tools you're using, right? And then, based on these suggestions, you can say, if I think the APP will reach 700, right? 700 by end of the month, what is suggests butterfly? Yes, we have distribution. We got wrong stock. Did I get the wrong stock? F11 APP. What did I say? I did say APP. Okay. Let's see what F11. Stuff. And go through this process again to suggest what are the expiration months, what are the strike prices. If you showed what your outlook is. Any questions so far?
Yeah, hey Vlad, we got a question just generally regarding butterflies. Would you consider butterflies to be, in your opinion, more of an advanced options trading strategy? And if that's the case, what's a good kind of step in? Earlier you kind of broke it down, the step-by-step of how to form a butterfly. But it seems like, what's a good step into, it seems like using Winston would be helpful to kind of explain the strategy and provide information to target what the individual is hoping to accomplish.
Yes, so I mean it's definitely an advanced strategy, right? You deal with three legs. These are ratio spreads, right? Where you have one long, two short, one long. You know, I mean, if you don't understand what a spread is, I would start with a spread, right? If you don't understand what are called vertical, like these two legs, I can just remove this leg and decrease this by one, and now it's a debit strategy. So I would first learn the debit strategy. We had some webinars where we talked about the debit strategy and how to construct this debit strategy. So the evolution, or like the learning process. First, you start with calls. You have to understand the call, right? Once you understand the call, then you basically say, well, I need to start thinking about probability because calls are expensive, especially if VIX is going up. Then how do I reduce my cost basis? Well, I can sell out of the money call, right? I can buy 680 call, and instead of paying $11, right? I can reduce my cost basis by $4 if I don't really think that the market is going to go much further than 700, right? You have, government shutdown, geopolitical risks, unemployment, pretty large jump in interest rates to the downside. So you can say, like, I'm bullish, but I don't think we're going to get above 700. So then you sell the call, and then all of a sudden, instead of paying $11, you're only paying $7. I need to make this bigger. And then the next step in the evolution, or your learning process, not evolution is probably not the right word, but in your learning journey, right, is you get from algebra to advanced algebra to calculus, right? You can't get to calculus until you understand algebra. But once you get algebra, this is probably advanced algebra, right? So the next step in evolution, if you don't want to pay $7.98, right, then you basically say, okay, I actually don't, either I just want leverage, and then I say, okay, definitely not going to go above 720, right? But we'll stay somewhere in that range, right? If that's my thought process, because Winston told me, and because I listened to Bloomberg, or because you have your own point of view based on fundamental and market view, then you say, okay, let me sell 720 strike. Okay. Okay, so now all of a sudden, instead of paying $7, I'm only paying $5. So butterfly, basically, it's more complicated because you're dealing with more legs. But I'm thinking about it as, I have a limited account, right? And you have this discussion, with other traders. They basically say, well, why don't you just do debit spread, right? If you have an opinion, the market is going to go just do a debit spread. Well, right now, the debit spread that I wanted to do, I have to spend, $800. What if my account is only $1,000? I don't want to spend all my money on one trade. So here, I'm reducing my cost by 50% and still participating in the trade. So that would be my answer. Thank you.
Gotcha. Thank you. Thanks for the explanation.
Any other questions?
I'm not seeing any other questions at the moment, and we are right up on our time frame here. So I'm going to ask Vlad to leave that screen up for a moment, just so everyone can copy down the contact information. Inevitably, someone will have a question later tonight or next week or the next day. So please feel free to reach out directly to Vlad regarding this presentation if you have follow-up questions. Vlad, thank you for taking the time to put this together and talk to us this afternoon. Keith, thank you for your insights as well. And thanks everyone who took time out of their schedules to be with us live this afternoon. And for those of you who are watching on recording, thanks for doing so as well. Just a reminder to everyone, if you're not already a client of Avant-Garde, I encourage you to go check us out at tradeagt.com. We're offering free commissions membership pricing for the rest of the year, so please feel free to take advantage of that. And definitely visit our site, tradeagt.com, hit that education tab, and sign up for all of our forthcoming webinars. Get yourself on the email list if you're not already on it. We look forward to having you back, Vlad and Keith, for another webinar, and thank you for everyone for taking the time. Until then, good trading to everyone, and we'll see you at the next one.
Thank you. Good. Thanks, Natalie. Take care, everybody.
Thank you.